two presentations for you tonight. Basics of pension, then advanced aspects of pensions and SASSs with Richard, a Q&A, and we'll close by 9:30. So as usual, that's me and a little bit about me and a disclaimer for both Richard and myself there. Just to remind you that this is part of a whole series of webinars. We've already done 3 of them, and we've got 8 in all scheduled up to the end of May, beginning of June, and then after the holidays, I'll probably have another half a dozen to finish off. I've already got somebody to talk to us about mortgages on this second half, this conveyancing. And actually project management as well. Not project management, drawing, architectural drawings for plans, for floor plans and HMOs and things. Okay, so let's move straight on to personal pensions. Just not to be mixed up with private pensions and personal pensions. They are the same thing, and they're usually set up by an individual rather than through an employer or workplace. A private pension is a way to save money for your retirement and get tax relief. Your money will usually be invested in the stock market, linked funds, and locked away until you reach the age of 55. And that's expected to rise to age 57. You then have several options, including withdrawing up to 25% tax-free, or even buying an annuity. Most private pensions are flexible and portable. So if you move jobs or become self-employed, you can continue contributing. People can contribute to personal pensions up to the lower of £60,000 or 100% of their pensionable earnings. Pensionable earnings do include wages and salaries and profits from trading activities, but they exclude investment income, including dividends and also property income. So that's quite important. Money saved into a personal pension is subject to tax relief up to a maximum permitted limit. You'll get tax relief at the basic rate, the higher rate, and even the additional rate of tax. So, for example, at the 20%, if you put £80 in, your pot will actually grow to be, not grow, will be £100, because HMRC will hand over the 20% basic rate, and you get the higher rate tax relief through your self-assessment tax return. There's a cap on the pension tax relief, which currently stands at 100% of your income with a maximum of 60,000. We mentioned that before when I said the lower of 60,000 or 100% of your pensionable earnings. And I also mentioned already that you can take it from 55 or 57, as it will become in a few years' time. Now, thinking about a director who has a limited company, directors can contribute directly from their company as an employer contribution. Although they will not get personal tax relief at any of the rates, that's basic, higher or additional, the company will get tax relief on the contributions paid. The director, of course, also avoids paying income tax and national insurance, because they haven't had to take the money out of the limited company in order to put into their pension fund. It's gone directly from the company into the pension fund, so they avoid the tax and national insurance on taking it out. Of course, the employer also saves on the national insurance. So this is a very good way to shift profits from a company to a pension fund. Okay, we've already talked about the 60,000, But didn't mention, and I've got a spelling mistake on the very bottom line. If the full 60,000 is not used, the unused relief can be carried forward until it is used, and that has a 3-year limit. And I know in Richard's slides he will mention that, because I forgot to add a line there just to mention the 3-year limit. And you have to use the maximum you can, though, in the current year before you can use relief going forward. Okay. A SIPP. A SIPP is a self-invested personal pension. It's really a type of private or personal pension, but it gives the member, or the owner, if you want, the person whose SIPP that is, some autonomy, some control over the assets you invest in. So if you remember before, I said that most pension funds are invested in the stock market. If you have a SIPP, you can actually control that a little bit more. You can choose to manage the investments yourself or with the help of a financial advisor. The type of investments you can choose includes bonds, shares, funds, etc. You get the tax relief if you're under 75 and you're a UK resident. Again, you get the basic rate and higher rate tax reliefs in just the same way. So, and we've got similar rules as the personal pension below, the age thing and the maximum of the 60,000, etc. It's just another form of personal pension, a SIPP. Perhaps Richard could expand on that a little more later. Now, thinking about workplace pensions. So we've already talked about personal pensions, and we've also already talked about employer pensions, or company pensions, where the company contributes on behalf of the director. Remember, a director is actually an employee. But now we're talking specifically about workplace pensions, and we're not talking about directors per se. There's really two forms of workplace pension. The first is the final salary, or defined benefit scheme. Most people call it final salary. It's just an easier term and is more descriptive of what it is. And your pension is linked to your salary and based on your rate of pay or your wages that you're getting at the date of retirement, and also the number of years you've been in the scheme. It doesn't rely on the performance of the investments. So really it's protected from the ups and downs of the value of the stock market and things like that, and you don't suffer the vagaries of retiring on a certain date, which might be bad in terms of the value of your fund, or even good if you're lucky. You pay a percentage of what you earn and your employer pays the rest, so they contribute. They offer inflation linked and guaranteed income for life. Like with any other pensions, you can take a tax-free lump sum, typically the 25%. A spouse will also ordinarily inherit a proportion, usually 50% of your pension on death, but otherwise can't be inherited by anyone else, for example, children, unless they're minors or in care. They're generally only available from national retirement age, which for most people is now 65 or even up to the age of 67, which I am. I'm not sure that it's gone beyond 67 yet, but I wouldn't be surprised if it does. And there can be a penalty for taking it earlier. Unlike personal pensions, which can be taken, as we saw before, from 55 to 57. Final salary schemes are now very rare, and most employers no longer offer them as they're very expensive for companies to run. They're the so-called golden pension schemes. You know, typically the very large public companies and also government, civil servants, teachers, etc. The other type of workplace pension, which is now the one that's used generally and certainly for new employees, are money purchase, not as descriptive as final salary, but the money you pay in it is invested, usually in the stock market, as we said before, and your pension is based on how the underlying investments perform. You'll normally pay a percentage into the scheme, and again, your employer will contribute a percentage as well. We'll go on to talk about automatic enrolment in a second. Okay, so here we are with automatic enrolment. Pension auto enrolment is a government initiative. Came in, oh gosh, about 5 or 6 years ago, to guess. Just can't quite remember now. To make sure companies provide pension opportunities for as many employees as possible. Each company in the UK must provide, that probably should read, each employer in the UK must provide a pension scheme. That is more opt-out than opt-in. That means that every employer eligible, and those are people between age 22 and state pension age, and earn at least £10,000, are automatically enrolled unless they opt out. With an auto-enrolment pension, the total minimum contribution is 8%, with the employer's minimum contribution being 3%. In some schemes, the employer does agree to pay more, and the employee can then contribute less, or even, as far as I know, can pay more and therefore save more. Yep, it says there you can pay as much into the pot as you like, but the maximum is also governed by the usual 60,000 and 100% of salary. Yeah, just as a note there, the employer's contributions don't attract tax relief at any of the rates, but it is free money. It's a free contribution from your employee, but you, of course, do get tax relief on your percentage contributions. Okay, so we got a few quick rules. Your employer can't refuse it if you want to join the pension scheme. Your employer does not have to contribute, however, to the pension if you earn less than £520 a month. The employer must pay any minimum contributions on time. You can choose to opt out. And if you do opt out, you can rejoin. And actually, you are automatically rejoined after 3 years. And then you have the chance, if you want to opt out again. Stakeholder pensions must meet the minimum standards. The stakeholder pensions came in before auto enrolment. And they were designed as really cheap schemes where the fees that the pension companies took were fairly limited. The trouble was at the time that the schemes weren't very good, and although the fees were pretty low, the investment returns were also not great. So really it was a swings and roundabouts at the time. But anyway, auto enrolment is really now the default. Yeah, I don't know. Yeah, stakeholder pensions. Excuse me for just hesitating there for a moment. I think I've talked about that. Right. Yeah, this is where I thought I was going to next. If by any chance you are somebody who otherwise can't contribute to pensions because you're unemployed, but do have some money, or for any reason you can't join a scheme, you can still use a stakeholder pension and contribute up to £2,880, which with the tax top up is actually £3,600. This is something that I think is quite interesting, and people should take a note of this. I wondered a little while ago, how do you know whether you're getting higher rate tax relief if you're on auto enrollment? And I looked into it, and I started learning something quite interesting about it. It is quite actually difficult to know whether you're getting the higher rate tax relief through the PAYE system that your employer is using. And it might be easy to assume that you are getting higher rate tax relief. That is, of course, if you are a higher rate taxpayer. But I don't think you should assume that. I think it's likely that if you work for a large, fairly sophisticated company, that you are, because there's actually two systems that a payroll system, an employer's payroll department can use. And they are relief at source scheme. Sorry, there's a missing line, but just about 4 lines down is the first method, relief at source scheme. And that is where you receive a basic rate tax up to your contributions by way of the pension company applying to HMRC to get the basic rate tax credit, as we've talked about before. Now, if you're on this scheme, you will have to use a self-assessment to claim the higher rate tax relief because you're not on the net payment scheme, which is where an employer, as I said, normally larger ones, apply to HMRC to use a net payment scheme in which you effectively agree to a salary sacrifice of the amount of their pension contributions. And because you've sacrificed that amount of salary, you're not paying tax on it. And because tax is done on a cumulative basis, it will also save you the tax at the higher and additional rates. So you need to know what scheme you're on. And the best way to do that is to have a look at your pay slip. But some pay slips are not detailed enough to know that. So if in doubt, ask your employer what scheme they're using. Okay, my last slide is about annuities. Pension annuity is a product that converts your pension pot into a guaranteed regular income. Going back around 20 years or so ago, when you reach the age of 75, it was compulsory to buy an annuity with the whole pot that you had. And they changed that because it really was a horrible situation to be in. Because if you cashed in your pension pot at age 75 for an annuity, although if you lived to a ripe old age over 100, you'd have been laughing because you'd have had 25 plus years of an annuity. If you died a day later, you lost everything. So they are less popular. It also depends what annuity values there are at the time you want to buy them. That's determined primarily by interest rates. And if you buy an annuity at a certain time, you'll cash in your pot and get, let's say, throw a figure, £20,000 a year. The same pot at another time might well get £30,000 a year, or indeed only £10,000 a year. So it might be still a good idea to have a look at annuity if the conditions in the marketplace are right and you can get a very good value one. But if not, then I suspect you'd probably avoid that. So I'm going hand over to Richard, and I'd welcome Richard. I know you're covering a few of the points I've made, and I'm not an IFA or a pension consultant, so I really knock that those slides up based on my own knowledge. So I'm very happy for you to comment on anything I've said, correct anything, or just review it in the duplication that I know is in some of your notes. Just to introduce Richard before he shows you his slides, which also tells you a little bit about him. He is a pension consultant in Ramsbottom, near to North Manchester, Greater Manchester. And he's a director of his own company, which specialises in offering self-administered pension schemes, SASSs. And I will hand over to Richard now. Thank you.
Thanks, Clive. Good evening, everybody. What I need to try and do is share my screen so I can go through my PowerPoint. Is it possible to do that?
I'm just checking that you're still on allow screen share. Just a sec. Yeah, you should be able to. Saying multiple participants can, so you should be able to.
Let me try it then. Can everybody see that?
I think so, because I can.
Right. I might have to do it the way you've done, Clive, and click down the side. It may be necessary to do that, but I don't think that's going to cause a problem. So yes, as Clive has introduced me already, my name is Richard Mattison. I'm a director of the Whitehall Group. There is some overlap, I'm afraid, on what Clive's already said. So what I'll do is I'll try and go through those sections fairly quickly because I don't want to bore you, and then I might dwell a bit more on the product specific areas of this. First thing, a little bit of background about us. So we were formed in late 2011, so we've been around a little while now. We supply one type of product, which is a SASS. That stands for Small Self-Administered Scheme, and I'm going to explain what all that means in a little bit. We fulfill specific roles for SASSs, which is a scheme administrator, which is a formal role registered with HMRC. We are the administrator with a little a, which means we do the day-to-day admin, moving paper and money and updating records and things like that. And we're also a trustee of each pension scheme. We are not financial advisors. So it's important to stress that nothing I say should be treated as financial advice. And as a business, we give generic information only and not financial advice. We run about 1,750 pension schemes with about 1.1 billion assets under administration. And our sort of key features in terms of our service are that each case has a designated account manager. So you have a point of contact. We provide online banking, so we can move all the money around online on receipt of the required instructions from our customers. We have online facilities, so everybody can see all their information through our website or through our app, including all their bank transactions and contributions and pension transfers, and their fund value, their fund allocations, their retirement benefits, all that stuff. We think we know what we're doing. I've been doing this for 34 years now. So, and we have a number of other very experienced people within the business. And we operate with a flat fee menu. So our fees are not percentage of fund based, which means it reflects the amount of work that we do on any particular thing. And effectively, the bigger your fund gets, the cheaper it gets as well, which is quite handy. Now we're going to overlap with Clive a bit now for a couple of slides. I wanted to sort of explain briefly why people bother using pension schemes in the first place. As Clive said, these are the pension scheme is just a savings plan for your retirement, and then there's loads of other ways of saving for your retirement that people use. So, you know, why would you bother using a pension scheme? And there's one answer, and that's tax relief. So I've tried to break it down in a simple little table here. So on the left, we've got money in. So what would tax saved when you pay money in? If a company pays money in, it saves corporation tax. Corporation tax is 25% on profit over 250,000. So you know, if a company pays a £10,000 pension contribution, it's going to save £2,500 just like that. Also, you can pay in money yourself, and that saves income tax. And the income tax you save depends on your rate of income tax, your marginal rate, highest rate. So a basic rate taxpayer, if they pay a £10,000 in, they're going to save £2,000 in tax. So already we're looking at a pretty good deal. In the middle, we've got the pension scheme itself. So you've paid your money in and it's sitting there, and the idea is that you invest it, and when you're doing that, you will save more tax. So first of all, you will save income tax because the pension fund pays no income tax on anything that it does, you know, dividends on shareholdings, interest on loans, rent on properties, you know, there's no income tax. You also save capital gains tax on any capital growth in value of investments that you make. And I've got the rates of capital gains tax there. That's for residential property and for other investments, and it's higher and basic rate tax. And that's with effect from the 5th of April. So I've included the budget figures. Also, more complicatedly, a pension scheme can save VAT on commercial property. And I'm going to explain a little bit more about that in a later slide. The last tax that you can't avoid through a pension scheme is stamp duty. So buying and selling shares or buying properties, you still have to pay the stamp duty, I'm afraid. On the right-hand column, we've got money coming back out of the pension scheme at the other end. First of all, you get 25% out tax-free. It's your 25% tax-free lump sum. Secondly, when you die, if there's any money left in your pension fund, there is no inheritance tax. So if you were subject to inheritance tax, there would be a 40% tax saving on passing that money on to your beneficiaries. Next one, Clive's mentioned this, no national insurance on a pension. And the rates of national insurance, 8% from April plus 2% on income over 50,000 quid. So what I'm trying to illustrate here is that this is a good deal. You know, you'd have to think twice about not doing this if you want to save money for your retirement. Again, a bit more overlap from Clive. Annual allowances, you know, this is the contribution allowance. So the maximum you can pay in per year, £60,000 per person per tax year. And that's into all the pension schemes that you might have. And here are some caveats or additional points. So carry forward. So first of all, if you've not used up your £60,000 in the previous 3 tax years, well, in fact, there's only been one tax year with 60 at the moment, the previous 2 were 40, then you can catch up in this year. You have to have been a member of a pension scheme in the year you're doing your catch up for. So you have to have an old pension scheme knocking around. You can't just set one up and carry forward from previous years. You have to have been in one. But here I've got an assumption. Let's say you pay £100,000 in this tax year. You would fill up this tax year first, that's £60,000, and then you go back to the oldest year, and then you fill that one up, and then you move forward from there. So £100,000 would then mean £40,000 in 2021. Second point, tapered annual allowance. So this is for high earners, and it's basically reduces the amount you can pay in for people on high incomes, which isn't very nice, but you know, that's how it is. And it's complicated, really annoyingly complicated. There's 2 definitions of income that you have to look at. I haven't included what that means here, but you know, that we can always provide that information. But if your income exceeds both definitions, then your annual allowance reduces by £1 for every £2 of income over the threshold amounts, down to a minimum of £10,000. And I've given an example here, but again, this is sort of fiddly and niggly and complicated, but if your adjusted income is, for example, 285 and your threshold income is 225, so you exceed both limits, you then take your adjusted income, your actual one, deduct the threshold figure of 260, take the difference, divide it by 2, and that's how much your £60,000 annual allowance is reduced. So my example is it goes down to 47,500. So that, as I say, that's for high earners. Last one, money purchase annual allowance. That is for people who have started drawing a pension. So not just tax-free cash, but a pension. And if you've started doing that, then you can only pay £4,000 in per tax year. So that restricts you quite a lot. There's just things, you know, worth knowing. Right, I think this is my last overlap with Clive. It's just about how you get tax relief on your contributions. So personal contributions, you've got to have earnings at least equivalent to the amount you pay in. So if you're going to pay in £100,000, you've got to have taxable earnings of £100,000. Taxable earnings, Clive's given more information, but it's salary, bonus, P11D, self-employed earnings charged to income tax. If you've got no income, you can still pay £3,600 a year. And the way you pay money into a personal pension is you pay it net of your basic rate tax. And then, as Clive said, it then gets grossed up. So if you want to pay £20,000 into a personal pension, you actually pay 16, and the balance is claimed by the pension company. And then if you're a higher rate tax payer, you claim another 4,000 through your self-assessment tax return. And another little caveat at the end, last bullet point is important. Company schemes like SASS, which I'm coming on to, don't do this relief at source. So if you pay a personal contribution, you get all your tax relief through self-assessment, all £8,000 in this example. Then on the right-hand side, we've got company contributions. So those are an allowable expense of the business. So the company just pays the money into the pension fund, just straight in. And that comes off the bottom line for corporation tax. So it just reduces profit and saves the tax that you would have paid on that if you hadn't paid it. You don't need equivalent taxable earnings to do this, which is really handy. There is a woolly rule called wholly exclusively, which is about how much a company can pay into a company pension scheme, and it doesn't really apply for owner directors because owner directors control what happens in the first place. So this wholly and exclusively definition is just, I'm just saying that it's out there, but if you're an owner director, you don't have to think very much about that. Another feature of company pension contributions is that a company can pay what is called unallocated contributions, which is it's paying more in than the annual allowance permits on the basis that it's not allocated to any member. And then it gets allocated in future tax years. So sometimes with what we do, you might have a client that pays in more than their 60,000 with carry forward, and then to fund something like a property purchase, and then reallocates that in future tax years. So rather than paying contributions in those years, it's allocating unallocated money to them. But to do that, they've got to have equivalent earnings like they do with a personal contribution. And just on the right, I've made a sort of little extra couple of comments about pension transfers, because you are, in most cases, allowed to transfer an existing pension scheme from one scheme to another. You can't really do that with public sector pension schemes. So that's important thing to know. And these DB, defined benefit final salary schemes that Clive mentioned, you have to have a financial advisor recommending you to do that, to be allowed to do it. So they're very limited in scope for transferring final salary pensions. Okay, I've got a slide on comparing what I've just said with auto enrollment, but I think Clive's covered this to an extent. There's no point me going through this slide except for my last bullet point, which is just to say that auto enrollment isn't very much. Don't rely on that if you want a comfortable retirement. Enough said. Okay, so moving on, I'm going to talk about the product that we supply. This is what we do at our company. And this is the scheme called a SASS, a small self-administered scheme. And the key points of what that actually means are, in this little wheel. So at the top, it's a company pension scheme. So you have to have an active limited company to set up a SASS. It's possible, you could set one up and then if the company's sold or it stops trading down the line, it's fine. The SASS can carry on. But to set one up, you've got to have an active company. The legal structure is a standalone trust. So to set it up, you complete a trust deed and rules, which is signed by you and us as the trustee. That then creates the trust. We then register that with HMRC. When it's registered with HMRC, it starts with a bank account. So each SIPP has a bank account. Now our preferred bank is RBS, but that's not an essential point. It's just what we do for our own administration. So you begin with a bank account into which your money goes. Now you can have more than one company attached to a SASS, which can be very useful. Either you might be trading through several companies that are making profits that you want to pay in, or it can be useful for loans, which I'll mention shortly. You can have up to 11 members of a SASS. They would have to have been an employee at some point of the company to join the scheme, but therefore you can have you can have like a mini group scheme for your company. And I'll mention why that might be useful in a moment or two. All the members must be trustees. So when we set up one, the members at outset have got to be a trustee. If people join later on, they have to sign a deed and become a trustee. That means all the trustees are involved in the decision making with the scheme. They all got to agree. And the last bit here, the SASS is what HMRC call a member-directed pension scheme. And that means that the member trustees make the decisions. You choose. So unlike a auto-enrollment scheme or a large employer scheme or a public sector scheme, you're deciding how that money is invested. And what the choice, I'll come on to that because that's very key to the point of a SASS in the first place. So why would you want a SASS? We call them entrepreneurs' pensions. Okay, now in financial services, there is a very important piece of regulation that came in last summer from the FCA called the Consumer Duty. And one of the important things about the Consumer Duty is about selling financial products to the right kind of people. So we put a lot of effort into explaining what SASSes are and saying you should only have one of these if it's right for you. So if you're an entrepreneurial type of person, this may be the product for you. If you're not, you probably don't need to know about this. So the first reason to have a SASS as an entrepreneur is the flexibility of investments. It is the most flexible type of pension scheme available in the UK. You can't get more flexible than this. And I've put down a list on the left-hand side of basically breaking down the investment choice that you have. Now, each one of these points is worthy of a presentation in its own right. So this is skimming across the top. But you can go from your bank deposits, from your initial bank account or any other fixed term deposits, things like that you might want, right down to the most sophisticated and complex type of investments. And listing here, you've got unquoted shares, private equity, unregulated funds, loans to third parties, peer-to-peer lending platforms, property syndicates, and e-puts, which is exempt property unit trust. You've got really complicated stuff there. A big shout out for commercial property, which is on the list. It's one of the most popular things which is used. But it's about the choice, and the choice is yours, as I've said. The other reason for having a SASS is the flexibility of benefit options, and that's the right-hand column. So you get all your choices here, all in one product. Your tax-free lump sum, flexi access drawdown is drawing your pension out of the fund and not buying an annuity, like Clive was explaining. Cap drawdown is an old-fashioned type of drawdown, which some people still receive. Uncrystallized fund pension lump sum is another version of drawdown, which some people use. I won't go into the detail of what that means, because it's about flexibly drawing your money out of the pension fund. You get these lump sums. You can take your money and buy an annuity. You can just take it, cash in your SASS, buy an annuity with an insurance company. They will pay you a pension from there on in. And then the big point here is family pension schemes. So you can't have a family pension scheme unless you've got a SASS. They can have 11 members, unlimited beneficiaries can join when people die, and you can build up family pension schemes with a coordinated investment strategy, really useful for family businesses or businesses where the kids are then joining the company, or even the grandkids. The pension fund allows death benefit options where the fund gets passed down the generations. You don't have to just cash it in and take it all out or move it to another scheme. It can stay in there, and the beneficiaries inherit that pot and carry on with that investment strategy. Really good family scheme, sort of succession planning idea. Okay, so as I've sort of alluded to, each one of those investment choices is a presentation in its own right. And I don't have time, it would take days to go through it all. So I'm just picked out a few key sort of case study type examples, just to try and illustrate to you how this works, and where it's useful and where it might not be, to give you, try and bring it to life a bit. So the first one is just really, I would call this a standard commercial property purchase example. And what I'm saying is, I've got an example of a commercial property being bought for 200,000 quid. It's subject to VAT. The property is vatable. It's going to be let back to the client's company. The rental is a 7% yield. That's £14,000 a year. I've used a 10-year period for this. I'm assuming the value of the property goes up by 5% every year, and that's just a straight line, 5%. And I'm also assuming that the acquisition cost was 2,000 quid, and the company is going to pay it, because the company can pay the costs of running the SASS. The 2,000 quid is pretty cheap, but anyway, it's just a figure. So how does it work? First of all, the company is going to pay a pension contribution of £241,200. That covers the purchase price, the VAT, and the stamp duty, because VAT is payable on top of stamp duty as well. So you pay tax on tax, which is a disgrace. But anyway, those are the rules. So you've got to pay that money in. Now, straight away, because it's a company pension contribution, you're saving corporation tax by doing that of 25%. So you've saved yourself 60,300 quid immediately. Then the SASS will reclaim that VAT. So you've had to pay it, but you then reclaim it. So you get £40,200 back into your SASS pot, into your SASS bank account. If the company pays the acquisition costs, it's an allowable expense of the business. You save 25% of that. It's 500 quid, not a lot, but every little helps. Then the company is going to rent that property from your SASS. So over 10 years, it will have paid £140,000 in rent. That is an allowable expense of the business. saving 25% corporation tax. That's £35,000 saved. And you could also argue, or I'm arguing, that by doing this through a pension scheme and knowing that the pension scheme pays no tax on its income, then you're saving tax within the pension fund on the rental yield that's being accrued. So if you're comparing that with corporation tax, you're saving another 25%, which is another 35 grand. Then you've got the tax-free capital gain in the value of the property. So over 10 years, at 5% a year, it's grown by £100,000. You've saved all the capital gains tax on that. Capital gains tax in a company is corporation tax. So you've saved another 25%. You know, if you were comparing this with yourself personally, then it would be, what did I say, 22% or something like that. But I'm using, you know, company tax in my example. So you've saved another 25,000 quid there. And finally, at the end of 10 years, you've built up a pension pot of £440,000, from which you can take a 25% tax-free lump sum. And assuming you were a 40% taxpayer at that time, you will therefore save £44,000 in income tax, giving you a total tax saving of £240,000, which is basically what you paid for the property in the first place. So in this example, you got your property for free. And I say that's a, you know, that is a conventional SASS property purchase example. Right. Moving on. We've now, I'm now looking at loans. So one of the features that a SASS can do is make loans, which Clive was talking about SIPPS and how SIPPS are a flexible type of pension scheme as well. The SIPP can't make loans. A lot of the stuff in that list I gave you, SIPPS can't do. SIPPS are very flexible, and I think they're excellent products, but this is going that step further. This is the entrepreneurial, the real entrepreneur's pension. So loans. First of all, a loan can be made from the SASS to a participating company. That's your company. And as I said, a SASS can have more than one company participating, so you can bring in other companies, and the SASS can make loans to those companies, depending on what you're doing with your business. You know, which company do you want to lend to? There are specific rules on this. So the maximum loan is 50% of the fund value. So you've got to, you know, have a decent sized fund for this to be worth looking at. The loan must be to assist the company with its trade. Okay, that's important. So you can't make a loan from your SASS to your company and then take it out as a director's loan and go on holiday. You have to use it for the trade of the business. The minimum interest rate is 1% over bank base. So that means you'd be paying 6.25 at the moment. The SASS could charge more interest to the company if you can get evidence that the company can borrow at a higher rate than that. And some people want to pay more interest into their SASS, you know, because it's their money. You're paying in, you know, you're paying back a loan to yourself effectively. The maximum term is 5 years. You have to repay the capital and interest in equal installments, at least annually. So let's say you borrowed 100 grand out of the pension fund. By the end of year one, you'd have to pay back £20,000 plus a year's worth of interest. So you've always got to take cash flow into account when you're thinking about this. The loan must be secured by a first legal charge on an asset that's worth at least the loan capital and the interest over its term. So you have to have something you can put up as security. I've given some examples of what is suitable security here. The best one is always property. Always property. You know, it works better. That's why, you know, banks give loans, you know, give mortgages and secure them on houses, etc., because property is the best form of security. But if you've got other assets like some forms of, you know, large machinery, resaleable business assets, like I've said, a franchise agreement here as an example, something that's got value that can be resold if your pension fund has to foreclose on your security, which is, you know, what would happen if you don't pay your loan. And also the security could be assets which are not owned by the borrowing company. effectively, it's allowed to be assets owned by anyone, not even owned by you. We've had cases where clients, mum and dad have put up the security for a loan to one of the kids' businesses as a way of getting it started, things like that. So there's things you can do, and I've used examples like a holiday property, with no mortgage, a personal investment portfolio, for example, could be used. The middle box is loans to unconnected parties, completely unconnected. And the terms or the rules are much more flexible. So it's got to be for business reasons again, even if it's to an individual, must be for business reasons, like they're a sole trader, for example. The loan cannot be to purchase taxable property. That's a new word I'm bringing in now, taxable property. Taxable property means residential property and tangible movable property. And tangible movable property usually means things like yachts and cars, fine wine and stamps and jewelry, but it also means movable machinery, vehicles, some business assets like that. So a loan to an unconnected party, you've got to be careful that you're not making it to that party so they can buy taxable property. Otherwise, straight away, it's not allowed and you're in trouble. If the borrower is a person, you've got to lend at least £25,000, and that's something to do with the Consumer Credit Act, which I can't quite remember. The revenue say a loan must be prudent, secure, and commercial. So you would have to make sure what you're doing with your pension loan makes sense. Don't be daft. Okay, don't lend it to a friend who you've met down the pub or something like that. Think about it. This is grown-up stuff. The interest rate, the payment terms, whether you have security or not, can be negotiated with the borrower. So you have flexibility there. A loan to your company, you don't. You've got to stick to the rules. But here you can negotiate those terms. Now, making an unsecured loan, I'm not sure that's particularly prudent, but it can be done, and it is done. People do it. And also, there's no limit to the percent of the fund that you can lend to a third party. So you can lend more than 50% of the fund if you wish. The last box on the right is just to make it crystal clear that a SASS cannot lend to a connected party that is not a participating company. So you can't make loans to yourself, other scheme members, family members, or business interests that you have that are not participating companies in the SASS. So you've got to be careful. If you're looking at SASS loan, make sure you're lending to the right entity. Okay, now I'm going to sort of try and bring again this to light. Now, this is just one strategy, one idea. A simpler idea is where a client has a SASS and they make one loan to their company because they want to buy something with the business, and to them it makes a lot more sense to pay loan interest to themselves than to a bank. Okay, it's just one-off loan for a one-off business purchase, like computers or stock or a new business premises or fleet of vehicles, something. Okay, and loans to client companies, loans to participating companies can be used to buy taxable property like vehicles and residential property if that's what the company does. Okay, so if that's what the company's purpose of trade is, and that's your SIC code on Companies House. So if you've got a company which has the relevant SIC code, it's buying, selling, and letting real estate, for example, then what I'm going to talk to you about now is possible, because that your company, the loan is to help your company with its trade. If this was a loan to a third party company, it would not be allowed. Okay, so this is a loan to a participating company. And this example is sort of, I call it loan accumulator. And it's used by people trying to build up buy-to-let portfolios within a property company by using their pension fund to get them started. It usually means they've got to have a bit of capital to start, just something to get them going with, and also they've got to have willingness to get stuck in here. This isn't a passive investment strategy. So let's look at year one. At the top, we've got the SASS. So you're starting with a SASS fund of 300,000 quid. And the SASS is going to make a 50% loan to the company. That means there's 150,000 quid left in the SASS, which is going to be invested in other assets. You're going to decide how you invest that. The loan interest over in 1 year on that 150,000, 6.25 is 9,375. And I'm assuming that you go and invest in something else with the other half and you get 4%. Okay, so you're making 6,000 quid on the other half in the first year. If you go to the bottom section, you've got what the company then does with that loan. So the company is going to use that money to buy a property, let's say buy a residential property. And this is where some nous comes in, because you're going to buy the property at undervalue. So you're going to get it at probably less than it's really worth, which then allows you to borrow the full amount to buy the property. Because remember what I said, the value of the security has got to cover the loan capital and the interest over its term, which means you can't borrow the full purchase price of the property. You'd have to borrow slightly less than the purchase price. But if the property is worth more than you're actually buying for it, because you're getting a good deal and your valuation is higher than what you're buying it for, then the amount that you can loan is linked to the valuation, not the purchase price. So that might be a bit of a complicated concept, but I hope I'm trying to get that across. You then use that money to refurb that property. Okay, so this is where your business acumen comes in. You're going to refurb the property and get it revalued after a year, and you've gained capital growth on that property. And I'm assuming you've done pretty well with this, and you've got a 33.33, 1/3% uplift in the 1/3 uplift in the value of the property. So you've managed to get it valued at 200,000 quid after a year. You're then going to refinance that. So you're going to pay the SASS back its money. So you need to refinance and get a commercial mortgage on a 200 grand property at 159,375. So that pays back your SASS capital and 1 year's interest. Okay, now assuming that's what you've done, you've created equity in your first property at 40,625 quid. So your company is now worth that much. That's your equity in your company, in the property owned by your company. And at the end of year one, you've only just managed to complete your refurb, get it let, get your commercial mortgage. So you've got no rent. You haven't earned any rent yet. Then you move forward to year two, because now you've got 315,375 quid in your SASS. You then do a 50% loan to the company again, and you reinvest the rest at, going at 4%. Your interest on your SASS loan is 9,855. You're earning 6,307 on your other assets. The company does the same thing again with its loan. It buys another property at undervalue, refurbs it, gets its capital growth on that. You then get a commercial mortgage based on the revalue of the property. You repay the SASS. It's 1 year. It's 1 year's interest and its capital. You've created another chunk of equity in your property company, and this time you've earned some rent on your first property because you've had a year's worth of rent on that. And I'm assuming the rental yield on these is 5% gross, with a 50% surplus over your mortgage payments. Okay, so I'm trying to make it realistic. And so you've made 5 grand in year two on your first property that you bought in year one. Okay, and so on and so forth. You continue to do this one property every year, building it up. And I've just stopped at 5 years. You don't have to stop at 5 years, but I've stopped at 5 years. And after 5 years, I now have a SASS fund worth £384,964. So I started with 300, now it's 384. It's not bad. It's not massive, it's not bad. But then you also look at what you've done with the company. So that you add up the equity in those 5 properties, you've got a company with £224,966, let's say 225 equity, but it's also generated rent over that period of £52,623, giving you a total company value of 277,589, which means your 300 grand that you started with has generated £662,553. So you've more than doubled your money here in this period. And also you've created an ongoing rental yield in your property company of £27,689. Okay. And obviously people tend to build up these property portfolios because that the idea is they're going to retire on the rental yield. So you can carry on, keep going if you wish. But this is just an example of a method of using a SASS loan to benefit a business, build up the business assets. Okay, right now my last concept that I'm going to cover about SASSes is unquoted shares, and this is quite complicated. It gets quite complicated. But the first key point about this is what the company owns. What are the assets of the company? This is absolutely essential because, I was talking about taxable property, buying houses and jewelry and art and vehicles and things like that. When you're looking at unquoted shares of private equity, you need to know what the assets of the company are. Very important. Does that company own taxable property or not? And when you're looking at a company, taxable property does not include business assets worth less than 6,000 quid, which means a company like mine, which owns telephones and computers, doesn't have any assets, business assets worth more than 6,000 quid. So I'm looking at this slide, a company with no taxable property. And then when you've just worked out what the company's assets are and whether it does or it doesn't have taxable property, you follow my flowcharts. So if the company only owns non-taxable property, which is assets for business management like computers and phones, and none of it's worth more than 6,000 quid, or it owns only commercial property, for example, then you're in this flowchart, and you only have to then look at whether the company participates in the SASS or has in the past, or it doesn't. If that company has never participated in the SASS, there is no restriction on the percent of the company that the SASS can own, and no limit on the percent of the SASS you can use to buy shares in that company. However, if the company does participate in the SASS, you can only spend just under 5% of the SASS fund on shares in that company, although you can do it in multiple companies up to a maximum of 20% of the SASS fund. And then I've tried to illustrate this with an example, which is basically, this is a real example. This is a real client. The numbers are slightly different. So I've got Alison and John. They run a shop fitting company. They've run it for a number of years. They've got 100 grand in combined pension savings. But what they want to do is start a kitchen design business. Well, they did start a kitchen design business because it was what Alison was really into. So what happened is they used a shop fitting company to set up a SASS, and they transferred in their 100 grand of existing pensions. And then they used the SASS to buy 50% of the shares in the new company for 50,000 quid. So they issued 100,000 £1 shares, and the SASS bought half of them, which was used as seed capital that bought the computers for the business, phones, stationery, design software, nothing over 6,000 quid. And it also was used towards the setup cost, the marketing of the business. Because the company owns no taxable property and it's not participating in the SASS, it's perfectly allowable. So they got this company off the ground by buying shares in it using their SASS. What's in it for the SASS, apart from the fact it's their money, well, they do want that that company to do well, because eventually, they either want to buy the shares back out of it or sell the company, and the SASS makes its money on that. In the meantime, they want the company to do well. They want to pay dividends, and the SASS will earn dividends. Now, that company could never participate in the SASS, but it could always have its own SASS. So, we're not restricting what that company is able to do either. Okay, now my last slide, I've actually had to print this off because it's so complicated. So bear with me. So this is a company that does have taxable property. Okay, so it has stuff that's not just low value business asset. It's buying houses. It's a property company. It owns a load of machinery. It owns a fleet of vehicles. It owns stuff like that. It could be, I don't know, a company that owns barges, riverboat cruises. Just pick something. In those cases, a SASS can only buy shares in that company if it qualifies as one of these two things: a genuinely diverse commercial vehicle or a trading concern. And then you have to go either side. So you have to look at what that company is and work out which one of these it is. And then you follow it through. So rather than just going through each one in total, in minute detail, you're basically saying that provided this company you're looking at is either qualifies as a trading concern, which is a small trading company where you could buy limited shareholdings, or it's a pooled investment vehicle. So you get these unquoted companies that are pooled investment vehicles with lots of shareholders, and they're going and buying, I don't know, a block of flats, let's say, developing a block of flats, and they're looking for lots of shareholders. Provided that company meets these definitions, then you can go and buy shares in that company with your SASS. And the last section of that is whether that company participates in the SASS. So if it participates in the SASS, you're still limited to this 5% of your fund. But if that company does not participate in your SASS, then there is no restriction on the amount of your SASS that can be used to buy shares in that company. And so the big message here is that SASSes can buy private equity. There are some restrictions that you need to follow through and be careful that you're getting it right. But there are ample opportunities to buy private equity using a SASS, which you cannot do with any other kind of pension scheme. And that is it. It's any questions?
Okay, thanks, Richard. Before we have a look at some questions, I'd just like to say a few things. Firstly, as is common with these webinars, some of these webinars are very complicated and it's very hard to grasp. Even, I struggled with the last couple of things myself, for sure. I always remind people that watching these webinars is as much about giving you an awareness of what is available, so that if and when those things strike a chord with you, that you will be hopefully have logged it in the back of your mind that this is something that's there for you. You don't know what you don't know, but while some of the things Richard's and I've talked about tonight, particularly Richard towards the end there, are very complicated, at least you now know these things exist and they're possible, and that it's always worth having a look to see if you can do something. If you've got a SASS, if you can create a SASS, then that's the most flexible way to go. I personally have done a number of the things that Richard has talked about. some of which I've done with Richard and some of which I've done in the past before I met Richard. I have had a loan back some years ago, temporarily. Well, obviously temporarily because it's repaid within 5 years. I have made a loan to a third party. I have even taken a little bit of my tax-free lump sum, and it enabled me to buy a property at the time. My SASS did own my office, which I occupied and used as my office for about 20 years. I have to admit that until tonight, I didn't realise I'd saved 240,000 pounds, because actually the figures were not dissimilar to the example that Richard used. So I certainly didn't realise I'd saved quite that much, although the property didn't go quite as much up in value, so perhaps I didn't save quite as much, but I knew it was a good investment, but just not quite that good. Couple of other things just before we go to questions. If you remember when Aaron Richard is the person most of us on this have trained with in property, he did a bit of a presentation on using pensions, and he made us all stand up with our arms in the air to show that we weren't taking advice from him, and he took a photograph of us all, if you remember that occasion. And what Aaron very cleverly, in my opinion, described was that various different SaaS administrators, SaaS companies, providers, whatever Richard prefers to call himself, offer different how would one describe it? Different options within their permitted use of funds. It's not to say that some break the rules or don't break the rules, and certainly Richard doesn't break the rules, but some people, for instance, may not fancy dealing with these, what were the UPETs, unregulated something or others, that I'd never heard of and hope I never hear of again. But there may be some people who do what Richard does that just don't want to get involved with those things, so they don't have them on that list. And if you remember, Aaron used the analogy of different, not just different model makes of cars, but also then within the range of the cars, whether they had catalytic converters or they had this and they had that. And some models just didn't use to offer air conditioning, but some do. And Richard offers most of the optional extras, and that's why I think he's a good pension administrator. So just a couple of questions perhaps from me before we open it up. Can you just briefly talk about trading, and what the definition of trading would be? And I'm talking about loaning to somebody because they have to they have to be a trading company. Could you just comment on that, please?
Yes. So is this like a third party loan?
Yeah, probably. Yes. Yes.
Yeah. Yes. The basically the revenue, the way the regulations, because it's the revenue that determine these rules, say is that when you're making a loan from a SaaS, you're making it to a trading entity. It could be an individual, but the loan must be for the purposes of the trade of the business and not for anything else. So I was saying, don't borrow money out of your SaaS and buy a Ferrari. because
Yeah.
it's got to be for the trading purpose of the business. And one of the things we do is we always ask somebody, what is the purpose of the loan? And if it's for property company, we have to be careful, that the loan is not going to be used to buy a residential property. It could be used to refurbish a residential property, if that's the trade of the business, but not to actually acquire it. So there's an area of, not a risk area, but an area you've got to be careful with when making loans from these pension funds.
Okay, thank you. One of the things that seems to be a little bit of a blocker is that a loan back has to be secured by a first legal charge. And often if it's property, then you would that prevent you buying property? It would
Well, not necessarily. It's yeah. I mean, yeah. The debate, it's written into the legislation that
yes.
the loan to the client's company, a loan back, it's called, must be secured by a first legal charge. So if you're securing it on property, it's got to be property without a mortgage. Now, you could be securing it on the property the company is buying if the loan is big enough. You'd have to have a decent sized pension pot. Say you've got 400 grand and you lend 200 to your property company. That could be enough to buy a property outright, and then you secure your loan on that property. So your pension fund is acting almost like your bank is, by taking a mortgage, a legal charge on that property.
Yeah. Okay. Right, I'm going to ask if there's any questions. We've already got one hand up from Nick, so please start, Nick. Unmute yourself.
Hi, Richard, and thanks for a fantastic presentations. Very interesting to me. I haven't really considered SASS myself up to now because I'm actually already retired, but I'm looking at building a business as a legacy for my children and grandchildren, so I think it could be relevant. I hope the others will bear with me. These might be questions that are more personal to somebody in my position than everybody, but I'm currently drawing 3 pensions, including the state pension. I still have part-time jobs because I'm a workaholic, and I'm contributing to workplace pensions with them. So I suppose my question really is, when I finally retire from employed work, can I move those workplace pensions into a SASS? Do I have to be a member of that SASS, bearing in mind that I'm really building it as something for members of the family, either coming into the business or as other beneficiaries, if that's allowed? That's my first question, really.
Yeah. Well, the answer is yes. It's your pension money. So if you're moving it from your existing workplace schemes into a SASS, it's still your SASS and it's your money. I mean, ultimately, you don't ever need to spend that money. If you don't want to, you can leave it and it can be inherited by your kids, who just step in and inherit that. So you could set up a SASS and use it to buy, I don't know, start building a property portfolio with it. Even within the SASS, we use it buying commercial property, for example, developing rental yield within the pension fund, and never touch it. And then the kids will just inherit that from you, and they can carry on doing that if they wish, or sell it all and take it out.
Right. Is there any limits on how much I can put in, bearing in mind I'm already a pensioner? You mentioned a £4,000 limit, but I don't know whether that applies to SASSes or not.
Yeah. So if you are doing what they call flexible drawdown, then yeah, you're limited to £4,000 a year in contributions. Not in pension transfers, you can still transfer, but if you're contributing new money, then yeah, you're limited to £4,000. So it depends what kind of pensions you're already receiving. If they're called flexible pensions, or if you're receiving annuities or you're receiving pensions from a final salary pension scheme. Everybody's different. So it depends what you've got.
Well, basically, I've got 2 final salary schemes and a state pension, so it would depend
Right.
on the individual scheme, would it?
Yeah, yeah. So in final salary in retirement, you wouldn't be able to transfer those. You basically, well, you're stuck with them. So it's not
Yeah.
really going to work for you because you can't. I mean, you could pay contributions of 60 grand a year. So you could start a SASS and start contributing to it because a final salary scheme pension is not a flexible drawdown pension. So
Oh,
you need,
okay, that kind of it answers my question then. So
yeah.
I can pay up to the 60 grand limit, and I can transfer the whole of my workplace pension pots. Okay, next one very quickly. It's my company's a trading company. It's in sourcing. So could another SASS lend me as a third party? Could it lend me the money to finance an assisted sale, even on a residential property?
Yeah, well, yes. Somebody else, totally unconnected to you, can make a loan from their SASS to your business. Yes. Yeah, you can do that.
Okay, that's fine. And just very quickly, you're on the non-taxable property that you were talking about in the last couple of slides. The £6,000 you mentioned, is that per asset or overall?
Per asset.
Okay, thanks very much. Very clear answers. Thank you.
Sorry, unmute yourself, Felicia.
Hi everyone.
Hello.
Richard, thank you much for an excellent presentation. My question is, I've got one or two. Basically, I would like to make some money contribution to my pension, my SASS pension, and I wasn't quite sure whether to do it as an employee, my employee wage, pension or salary, or to use it to do my company contributing it into my SASS pension. Because obviously with my earnings is the minimum. I'm only drawing out the minimum, which is £9,000 a year. But if I went the company route, I could. It doesn't matter. There's no limit. But only the tax relief is only the corporation tax level, which is 19%. Whereas the personal route is the 20%, isn't it? Tax relief.
Well, yeah, corporation tax is 25% on profit over 250. If you're under
Yeah, I've
250,
got profit
it's
there.
still
Yeah.
it's 19%. Yeah, that's right. Yeah, yeah. So yeah, if you did a personal contribution of the 9,000, for example, that your salary is, then you get 20% tax relief on that.
Mm.
And you could, if you wanted to pay more, you could pay it through the company.
And it's up to 60,000, or there's no limit, is there, for the company route?
Yeah, it's up to the 60,000 plus any carry forward allowance that you've got available. So yeah, it's a lot more.
But the company needs to have profit of over 60,000 or more.
Yeah, well, to benefit from the tax relief, yeah, you basically reducing profit. So if you've got, I don't know, 40 grand of profit and you pay it all into a pension scheme, you pay no corporation tax. But if you've got £25,000 of profit and you pay £40,000 into a pension scheme, you're only getting tax relief on the profit element of that.
Oh, it's profit. Okay, so if you're making a loss, you can't carry forward the losses by adding your pension.
No, I don't believe you can. No.
That's an accountant question, since it's a Clive question, isn't it?
It is really.
If you do contribute more than your profits are, then you can reclaim some tax if you paid any just the 1 year before, and you can carry that loss forward against future profits. But it will restrict you in the following years to do another 60,000 and another 60,000, because the chances are you will never mop it all up. But although you'd have to do the figures, your goal might be to get money into the pension, into the SASS for that purpose. Obviously, you don't want to not have the tax relief, but there might still be some value in having the money in the SASS.
Yeah, that was my logic. That it's half the bread and half the wins, because
It
it's
could,
going
yeah.
going tax free.
It may be a little more than half, a little less than half. You would have to, we'd have to think about the numbers, but
Okay.
it wouldn't be the full loaf.
Okay, yeah, that's one. And then I think the other question was to do with SASS, the SASS side, if I may ask, Richard. Okay, I need to get it clear in my mind. If you definitely can't use a loan back to my sponsoring company to buy a residential property, to build up my buy-to-let empire, is that for sure?
If no, you can if that's what your company does.
Well, you know,
So
if you hold it, if no, I'm not trading it, but if I was to hold it and build up, because you're not, I know you can do it if you're trading residential properties like Barratt Homes, but if you're using it to build, like buy and hold, so it becomes an investment property, can you still do that?
yeah, if I can't, like I said, I can't remember the phrase for the SIC code. It's like buy, sell, and let real estate, something like that. Then yes, you can.
Ah, okay.
Of course, you can always change your SIC codes to whatever is both accurate and required, if that remains accurate, of course.
Yeah, but what I don't get, in the pensions manual, it talks about you shouldn't use your SASS funds for either directly or indirectly residential property. That's the bit I don't get. Then how can you then use it for?
There's a section about authorized employer loans. So if you're talking about the pensions tax manual,
Yes.
yeah, go to the bit about authorized employer loans, and that sort of covers that really.
So if it's authorized, and therefore you can use it for residential investment properties.
Yeah, because that's what the company does, and that's the sort of the key point. The company got to participate in the scheme, and that's got to be what the company does. It's got to be its activity with the right SIC code. Then it's an authorized employer loan. But if you did that to a third party, it wouldn't be allowed. That's the difference.
Okay, that's fine, because I'm not going to do that to a third party. Okay, and also then building up your pension pot, and then so that you can pass it on to the next generation. It's only tax free. They can only claim it. The beneficiaries can only do it up to age 75. It's then it's tax free, right? But after 75, they have to pay their marginal tax rate.
That's right. Yes. Basically, if you die before you're 75, it doesn't matter when you die, they inherit it tax free. There's no inheritance tax. But if you die before age 75, they can withdraw it all tax free. If you die after 75, they pay income tax at their marginal rate on anything they withdraw.
Okay, so it's still a good way of building up, back to what
Yes.
Annette was saying. It's a good way of building up your generational wealth in a way.
Yeah, I mean, ironically, what you seem to find people these days is they retire on other assets and don't touch the pension, which is ironic because pensions are there for paying you an income when you retire.
Yeah, but at the same time, anything pensions is in a trust, so it's tax efficient. Whereas my property portfolio is outside the estates, therefore is subject to inheritance tax. So it's more efficient to use your property income before you dip into your pension, right?
Yeah, yeah.
I think that's the logic, right? Isn't it?
That's right. Yeah, absolutely. Yeah.
Okay. Yeah. Yeah. Thank you. Thank you very much. Thank you.
Okay, thanks, Felicia. Ian, if you'd like to unmute, please.
Hi there, thank you very much. Yeah, Felicia, that's one of the questions I was going to ask, so that's good. I'm already drawing down on a small SIPP pension. I've taken the 25% of that and I'm drawing down on that one. But I have other pension pots. Would I still be able to set up a SASS with those other pension pots, which are defined? Well, some of them are defined contribution. Yeah, some money pots basically.
Yes. The defined contribution. Yes. Define any defined benefits. basically once they're in payment, you can't transfer them. But before payment, you could transfer them. But I was saying you have to have financial advice, and the advice has got to be that they recommend you transfer. And that advice is pretty expensive as well. But the defined contribution, the money purchase plans, yes, you could, yeah.
Right, thank you. How long does it take roughly or typically to set up a SASS?
At the moment, 6 to 8 weeks. So the way it works, somebody fills in all our application stuff, signs the trust deed, and then we apply to HMRC for registration. And it literally sits in a pile and works its way to the top. And they've only got a little team at the FCA that do all the registration checks for all the pension schemes that apply every year. It's only about 3 people, and they do about, I don't know, 2,000 registration checks a year. So you just got to wait for it to reach the top of the pile.
Right. And you mentioned fees at the top. Sort of how much does it? At what point does it not become viable to have a SIP or another way of putting it? What are the fees to setting one up and running it?
Well, our SASS fees are £250 plus VAT per member setup, £400 plus VAT per member annually in arrears. We have a minimum of 800 though, and a maximum of 1,200 annual in arrears admin. And then we have a menu of transactional fees for things like loans, properties, private equity, a thing called esoterics, which I've not even gone there, which is all the stuff like gold bullion and hedge funds and stuff like that. Retirement, death, divorce. There are one-off transaction fees for all those elements. So a loan 400, a property 650, a retirement 150, pension payroll 150, divorce 500, death 500. So it's a menu of fees.
And once you set up the SASS, and if you decided to do, well, presume you can do. Would the loan back to your own company have to be coinciding with purchasing a property in the example you used, or could you do the loan back and then? I'm trying to work out the timing when you're buying and making the transfer in the SASS, and whether it means you can make a quick buying decision, or whether it protracts the purchase out because you've got to get it through the SASS in order to purchase a property.
Yeah, well, you could, if you had something that you could provide as security, like an existing unencumbered property, you could lend the money to the company secured on that property. Then the company's cash rich.
Yeah.
And then you could buy through the company when the right deal comes along. The only caveat to that is you've got to think about your cash flow, because you've got to be able to pay the loan down in accordance with the regulations.
Yeah. Yeah. Okay. Thank you. That's very helpful. Thank you very much.
Thank you. I do use Richard, and I'm not advertising Richard here when I say it, but I do know that his fees are reasonable and very competitive. But if you're interested in talking to Richard, then you'll find that out. Dermot, would you unmute, please?
Yeah, I think thanks, Clive, for a great presentation, Richard. Thank you. I think Ian stole my thunder a little bit, so I was just trying to get absolute clarity on residential property. So if your limited company is purchasing residential company, it's got to be unencumbered for the SASS to be able to fund it. Is that correct?
Yes, if that property is going to be the security for the SASS loan, yes. If you've got something else, another property that you can offer as security, then no, you don't have to. Then the property you're buying can then be, you can get a commercial mortgage on that as well.
Okay, and you talked about a charge on the property. I guess anybody who's got a mortgage on on a residential property, obviously the mortgage company is going to have the first charge. Is it possible to use the second charge in order to use security for the SASS?
No, not for a loan to your company. No, you could do it if you're making a loan to a third party. But
Right.
that's, you know, sort of different set of criteria.
Right. Okay. Understood. And then taking money out of the SASS, if any of us ever get to that golden day when we say we want to start drawing on our pension, you know, it sounds like everybody else is here going the other way. But I take it we're just taxed at the prevailing rate at that point in time, yeah?
Yeah. So you get your 25% tax free, and then the balance, whatever you draw out, you pay income tax at your marginal rate. And you know, so you can structure it compared, you know, together with your other sources of income to try and stay at basic rate, for example. You
Yeah.
choose what you take out.
Perfect. All right. Thank you. That's everything from me. Thanks, Richard.
Thank you, Dermot. Agnes, please unmute.
Hi everyone. Thank you, Richard, for a very, very good presentation. I've got well, actually 2 questions probably. So in terms of SASS funding, and I will just briefly explain my situation and see what are the options, okay? There's one option I think of, but I don't know if this is viable in reality. So I am an employee of a company. It's not my company, it's just a big company, you know, I'm just an employee, where my employer and we contribute to a pension, okay? It's done a salary sacrifice, so I know I'm getting that, you know, straight away. Now, on the other hand, I've got a property company, okay, where I am a director. So on paper, the company does not have any employees because, you know, obviously I'm already paying and I somewhere else and stuff like that. Okay. Now, if I want to open a SASS for my property company, okay, then I understand that the company can contribute something on my behalf, but do I have to also be an employee of that company apart from being director in order to be able to put more, or the company can, you know, put up to, let's say, 60 grand per year? What is the situation here?
To contribute into a SASS for somebody, they need to be employed by the company. So with an owner director, the easiest way of doing that is just write yourself a contract of employment. Just have one. You know, get one off the internet and give yourself a contract of employment, and all of a sudden you're an employee. You don't have to pay yourself anything.
Okay.
But that's the easiest way. If you know, if you were audited by the revenue, that's the easiest way of covering that point off.
And then because the company, okay, so SASS can only be attached to a company which invests in commercial property, or any type of company. For example, the traditional BLT can also have a SASS.
Yeah, well, a property, yeah, if the property is owned by limited companies, it's got to be an active limited company. Yeah.
Correct. Yes, active limited company. And then there's another question: what the SASS does with the funds? That's totally separate matter. And now, okay, so if I will be an employee of the property company without actually, you know, being paid anything, how much can we put together? I mean, the question is, if there are sufficient profits, okay, can the company contribute 100%, you know, and I don't contribute anything? Is that is that legally possible or not? Because employee has to contribute something and company cannot contribute 100%.
No, the company could contribute 100%. You personally don't have to make a contribution yourself.
Okay.
No.
Yeah, I think there, Agnes, you're just confusing or other type of workplace pensions where there's a contribution from
I just
both
wanted to
parties.
see where the difference is.
This is very,
Okay.
very different.
Different,
As a
okay.
director employee of your own company with
Mhm.
your own connected SASS, then it's very flexible. Am I right there, Richard?
Yeah, that's right. Yeah.
Mhm.
Okay, thanks, Agnes, if
Thank
that's your questions for the moment. Unmute David, please.
Hi again, Richard. I know we've got a dialogue going at the moment, and I'm not going to speak to you about the trading thing. You'll thankful to know. I'm going to go back over maybe a little bit of ground that's been covered tonight, just to get absolute clarity for me on this loan back scenario, if that's okay. So if I say it for my personal business, so it'd be a loan back to a participating company that owns a couple of properties already. Its SIT code is 68209, which is other letting and operating of own or leased real estate.
Yes, that's the general SIT code that most people use. Yeah.
So there wouldn't be a first charge. Oh, and also there's like a lump of cash that I can put into that property company, as well as the equity. So I got told that if I had the property is valued by a surveyor and then the accountant ratified it, that I could loan against the loan back against the equity and the cash that was in there. Is that correct or not?
Do you mean that the properties have got mortgages?
They do have mortgages.
Right. Okay. So what we're talking about is using your shareholding in the company as security for the loan.
Yes.
Which, yeah, we do have a handful of cases where we've done that. Yes. So you've got usually it's more than two properties. You know, I'm thinking of one particular case where they've got about 20 properties in the company. All the properties have got mortgages, but all of them have got equity. So they're worth more than the mortgage. The company's accountant valued the shareholding in the company based on the combined equity of the business. And the value of the shareholding was used as security for the loan. So the loan basically took a legal charge over the customer's shares and then registered that charge at company's house. So it's not great. You know, like I said, the best security is property. You know, this is securing on private equity, which is the you know, private shares, which is the equity in a portfolio of properties. But it can, in theory, be done. Yes, yes.
Okay, and does the portfolio need to be larger, or can it be on a smaller number of properties?
Theoretically, not. No. You know, we as a SaaS provider would want a pretty robust company valuation or share valuation from your accountant to tick the box. You know, these things can be audited by the revenue, and you know, one of the things they ask for is a copy of the valuation of the security. So we'd want a pretty good one.
Okay, that explains it. Thank you very much.
That's very good, David. Just thinking about that, I don't know if the numbers work, but of course, if you have got, as you say, a lump of cash to put in, you might be able to pay off one of the mortgages and then or you know, and work it that way, because then you can release one of the properties to be a first charge.
Yeah, it doesn't. Yeah,
the maths may not work out.
Yeah,
but
the maths don't quite add up, Clive.
No, but that's could be, if that works for you. Sorry, if you think that principle works for you, you could aim towards that over the next whatever it takes in time to achieve that. But yeah, okay. Okay. Thanks, David. Raj, if you'd like to unmute, please.
I think Felicia was in front of me if she wants to.
I just chose you there because
I
Felicia.
haven't. I've
before.
had my go already. So I just
Yeah.
want to put a
You
question.
come back
So
if you have another question.
yeah, this is my
Yeah.
second one.
Yeah.
All right. Okay. Thanks, Richard. First of all, I missed the beginning of the presentation, so I might ask a question that you covered off early, and if so, apologies on that. But I have 4 different companies. I've got 2 property companies, one that's a trading, one that's a non-trading. I have a consulting company, and I have an investment company that I make investments from. Can all of these be part of one SaaS regime, or how do I manage that, and how do I think about that?
Well, the short answer is yes. You use one company as what they call the principal company, which establishes the scheme. Normally, the principal company is the one that you want to make the most contributions.
Yeah.
Usually the one generating the most profit. And then you can join the others as participating companies. And to participate, it's a paperwork exercise, really. You know, you sign a deed, you sign an application form, and those companies just need to make a small contribution, like 100 quid, and to participate, and then they're in.
Okay. And are there any advantages about then loans between those different companies then and so on within a kind of pension framework? I mean, I know I can loan money from company A to company B anyway, but when they're all in a SaaS, does it open up any different kind of opportunities to me?
Not particularly, no. I mean, the reason for having more than one company as SaaS is that you might want to lend to that company. So, you know, we've got quite a few clients that have their normal day-to-day trading business, which set up the SaaS, paid contributions out of profit. You know, they may have transferred other pensions in to create their pot, and then they have their property company on the side. The property company joins the SaaS as a participating company, and the SaaS lends to the property company to help it buy more property. So that'll be a typical scenario, but not really doing intercompany loans. It doesn't really help with that at all.
Yeah. Right. One last stupid question then. If you've got an offshore company, how does that play into this?
It doesn't.
Okay.
This is onshore stuff.
Yeah, no, I thought it was a stupid question. Okay, great. Thank you very much.
No such thing as a stupid question. So we've been told.
Yeah.
There's no more hands raised, and we are approaching 25 minutes past. So I do think it's probably sensible to draw a line here. For me, it was very interesting, even though I have experienced a number of these things: loans, loan backs, loans to, tax-free lump sum, using Richard now, and have used over the last 20 or so years 2 different pension consultants or providers. And I think that area that we all were asking questions about, because it's the one that we're interested in, let's be honest, of building up a portfolio of residential properties. Although there is certainly some restrictions there, primarily the first charge and things like that, I think if you're aware of this possibility, you can perhaps develop your SaaS and your company and your approach, especially if you've got years ahead of you to do that. You can certainly engineer things so that there will come a time when you can use that if it's not quite now, even if it's not quite now. So as I said before the questions, it's a matter of just being aware that there are possibilities, and not understanding to the nth degree or remembering everything that was spoken about tonight, knowing that there are the right people to talk to. Ian asked a very good question at the very end of last webinar. I think I'll always remember this question, because it was just about this point about how do you know how to find the right people to help you in the right circumstances. Ian's looking bemused, but I think he's hopefully remembered asking that question. And it's the same for us all. It is experience. It is recommendations and questioning, and that sort of thing. So, well, I hope you've enjoyed and learnt from the presentation tonight. And I think, we're going to thank Richard in the usual way. We can unmute or just do the clappy hands that we do. Say thank you for and everyone have a good night and weekend. You will get recordings. Richard's there to ask, to approach, to email. If you want, you can come through me, ask questions on the WhatsApp, and then I can go to Richard for any help, I'm sure, any clarifications for you. So let's leave it at that. Thank you.
Thanks a lot.
Thanks,
very much.
Richard. Really
Okay.
appreciate coming on board. Thank you.
Okay.
Thank
Bye-bye,
you.
everybody. Bye.
Bye. Thanks, Richard. Thanks.